Welcome to the next video in our series. This one is called What's My Profit? We're going to cover a lot of material in this module, and remember, you can pause, rewind, rewatch as many times as you need to. Our goal for this video is that you will understand how your profit is calculated. You're taxed on your profits. So that's why it's so important to understand exactly what goes into the calculation of your profit, so you understand then why you're paying the amount of tax that you're paying. We all know we have to pay tax, but what we want to make sure of is that you're not inadvertently paying more tax than you're due. And one of the best ways to avoid paying tax that you don't actually owe is by understanding just exactly what impacts your profit, learning exactly how your profit is calculated. Now, there's also lots of other great reasons to understand your profit. We're going to go into those in great detail in this module also, but of course, I started with the tax one because, most of us were looking to save money, and so that's the one that's usually the most motivating. If your business isn't making a profit, then let's be honest, your business is not going to stay around for very long. That's why it is a key metric to watch in any business, because it tells us how healthy is this business. Is it a successful business? And we really want to know that while we're operating. We don't want to have to wait until 18 months after these transactions have taken place to learn that, in fact, we're not actually making a profit. By then, you could have wasted an awful lot of money. We really want to know this information on an ongoing basis. We should all, as business owners, aspire to know, what was my profit last month? Not what was my profit last year, but what was my profit last month, last week, so that we know on an ongoing basis what is the health of our business. The structure of our business determines the method by which our profits will be calculated. Directors of limited companies, for example, are considered employees in the business. Therefore, they're paid wages. Those wages are included in the business expenses, and those wages are taxed at income tax rates, similar to how you would have been paid and your tax was deducted when you were an employee of another business. Profits left over after the directors have been paid and all the other business expenses are calculated are then taxed at 12.5% corporation tax rates. Now remember though that if as a director you want to access any of those profits at that point, that would then become salary and you would have to pay income tax on them. We will learn about this in a lot more detail in our next video called What's My Tax? Sole traders and partnerships are taxed on the profits of the business. The business's profits are like the sole trader's gross pay, and then income tax is calculated on those profits at the same rates as PAYE employees. Again, we're going to look at this in a lot more detail in the What's My Tax video. So now back to our profits and how are our profits calculated. So let's start with the maths. Let's say our sales are $150,000 and we have business expenses of $100,000. That means our profit is $50,000. It really is that simple. But of course, there are always rules, and let's learn those rules. There's 3 rules you need to know. If you're VAT registered, then all the figures in your profit calculation are ex-VAT. You never include the VAT in your profit calculations. The sales are what you sold, not what you've got paid for. The business expenses are what you've invoiced, not what you've paid for. Sales. So what you sold, not what you got paid for. What do I mean by that? It means that once you've sent an invoice to your customer, that amount, the ex-VAT amount, will be included in your profit calculation, even though your customer hasn't paid you for it yet. Similarly, with your business expenses, once you've received an invoice from your supplier, that amount needs to be included in your profit calculation, even though you haven't paid the supplier yet. We have 3 more rules. There are 3 types of business expenses. You have allowed expenses, you've got capital expenses, also known as fixed assets, and you have expenses that simply aren't allowed for business reasons. The allowed expenses, only those are going to be included in the business expenses calculation for your profit. Only a portion of the capital expense will be included in the business expense calculation. It's called a capital allowance. That's what it's called for tax purposes. You may also you may have heard of a depreciation that's similar to capital allowances. Capital allowances is what the revenue calls it. The not allowed expenses, these will not be included in your business expense calculation at all. We're going to have a little pop quiz here. See if you can determine which category this is. So employee wages, do you think that's allowed, capital, or just not allowed? That's an allowed expense. I'm guessing you got that one right. If you're a director of a limited company, your wages will also be included in employee wages. However, if you're a sole trader, your drawings won't be included in business expenses at all. Our next video, again, What's My Tax, is going to go into full detail on that. Which category of expense is company van? Would it be allowed, capital expense, or a not allowed expense? Company van is going to be a capital expense. I feel like that was an easy one for you too. Which category of expense is taking clients out to dinner, taking them out for lunch? I know, but I hate to be the bearer of bad news, but that's classed as entertainment and it is not allowed as a business expense. If you're taking your clients out for a lunch or for a dinner, you're expected to pay for that with your own funds. Which category of expense is telephone bill? Of course, that goes into allowed expenses, but there is a disclaimer here. If it's, your household phone, it's also used for work, you may only be entitled to a portion of that expense. Now that we have some more detail, let's go back to our maths. So you've got sales of 150,000 less business expenses, which are made up of wages, which is allowed, of 95,000, telephone bill, which is an allowed expense of 4,000, company van 8,000, but we're not allowed, a client out to dinner of 2,000, again we're not allowed, so we have a profit of 51,000. So how do we pick up the extra 1,000? Because at the beginning, our math was 150 minus 100,000 gave us 50,000. It's the capital allowances. So remember our first video, we looked at a definition of fixed assets. You may also hear them called capital costs. Now, I just want to stop and go off on not really on a tangent, but discuss this in a bit more detail, because I know the way business owners think, and let's say you might be looking at the profit and you're thinking, wow, that's a lot of tax. And you think, I've got a great idea. I need to buy a piece of equipment, and instead of paying tax on 50,000 on all that money, why don't I, upgrade my premises? Why don't I buy that piece of equipment that I need? I can, pay for the thing, and I will reduce my tax bill in the process. I like the thinking, but that isn't how it works. Remember that anything that's deemed to be a fixed asset is depreciated over a period of 8 years for tax purposes. So that means if we buy the company van for 8,000, we divide that van by 8 or multiply it by 12.5%. We get the capital allowance, which gives us €1,000. If we go back to our calculations, we can see that the 1,000 is a depreciation on the van. So we get 1,000 of that van each year for the 8 years until the total cost of it is written off. And that's where we got our profit of 50,000. So let's discuss something else now. How do we know which transactions go into our profit and loss? And what I mean by that is the date of those transactions. And it's very important that you know your accounting year, because that will determine the date of the transactions that are allowed into your calculation for profit and loss. The transactions that you include must be dated within your accounting year. So if you're not sure, find out from your accountant what is your accounting year. Many businesses are based on January to December, but it could be any 12-month period. So it is important to find out the correct details. So for example, let's go back to our calculation. we have 50,000 in profit there, and we're thinking, how can I reduce that? Because, you want to reduce your tax bill. And let's say you're working on your 2021 accounts, and then you get in this invoice. It's for 10,000. That would be a nice chunk off that 50,000, but it's dated in January 2022. You are not able to include that in your 2021 accounts. Let's just take a moment here and ask ourselves, do we actually want to reduce our profits? Does that suit our circumstances? We pay tax on our profits, and most of us are always looking to save money and reduce our tax bill. But what are your financial goals? What's your personal circumstances? What stage you are at in life is important to consider when you're looking at your business. For example, do you want to get a mortgage? Are you going to want to get a mortgage in the next 2 to 3 years? In that case, you probably want to show high profits. Do you want to sell your business in the next few years? In that case, also, maybe you want to show higher profits. Well, of course you want to show higher profits if you're planning to sell the business. And this is why knowledge is power. This is why the more you know about this stuff, the better you can use that information to improve your life. It's worth taking some time to think about your circumstances, what's coming up for you in the future, and setting some financial goals. I would advise speaking to a qualified professional. Discuss your circumstances, your upcoming situations. Questions like, will the kids be going to university in a few years? So in the next 3, 4, 5 years, is that when your kids will be going to university? Does that mean you'd be looking to qualify, hopefully, for SUSI grants? The outcome of those discussions, those plans, can inform how you present your business. Let's just swing back to our calculations again for a minute. You may have noticed we have very little expenses headings. Is there a chance we're missing some? We've only got wages and telephone, and we've got capital allowance. Surely we spent more on the business than that. So you might be thinking, does it matter if I'm not perfect with my receipts? If I'm a bit slapdash, I lose the occasional receipts. So let's just do some math on that. Let's say you find receipts to the value of $6,150. What does this mean for your finances? So the receipt total is, let's say, $6,150. First of all, let's calculate the VAT on those receipts. Now, I know I'm making an assumption, but let's say those were at 23%. I'm doing the worst case scenario. I'm aware of that, but we'll go ahead and do it. We'll just look at what it means. So that's, first of all, $1,150 in unclaimed VAT. So let's look now at the impact on our profits. So we had profits of $50,000. But if we were missing receipts to the value of $5,000, that's reducing our profit to $45,000. The original profits were $50,000. Corporation tax of 12.5 on $50,000 comes out to $6,250, meaning we'd have to pay that in corporation tax. But let's say our accurate profits are actually $45,000. That means our corporation tax should only have been $5,625, which gives us a difference of €625. Now, what about the VAT we didn't reclaim? That was $1,150. So we're in fact overpaying $1,775. What if you're a sole trader? Well, then the picture is going to be a whole lot worse. Just remember, for sole traders, you're being taxed at income tax rates, not corporation tax rates. Now, personal circumstances determine your tax rates, but we can do an example based on standards. So our original profits were $50,000, but the accurate profits were $45,000, giving us a difference of $5,000. We're going to look at standard rate cutoff for a single person or a married person whose spouse is also working, $36,800. That's our 2022 rates. PAYE tax rate on anything over the cutoff is 40%. The PRSI is 4%. The USC is another 4.5%, meaning we get 48.5% tax. So in other words, if we have an overstated profit of $5,000, the tax on that is $2,425. That's our overpaid tax. Now remember the unclaimed VAT as well, the $1,150. So now our total overpayment, $3,575. That's from missing out on a bunch of receipts. So I'm thinking it's a good idea to mind those receipts, and there are easy ways to track them, we promise. Well done! You have reached the end of this module, learning about what's my profit, how your profit is calculated. That's a great job. The next video in this series is what's my tax.